Hello, everyone, again. This is Cathie Wood from ARK Invest, CIO, CEO. So I'd like to go through once again by fiscal policy, monetary policy, economic statistics, and some market-related statistics, what's going on out there. So first of all, in terms of just setting the stage, the markets got a little wobbly this week, partly because many of the bears who had been hibernating as the market was rebounding from the March lows, they started coming out of hibernation and talking about the stock market in a very unfavorable way. In other words, they're very bearish. Stan Druckenmiller was at the Economic Club of New York. I listened to that. He has given the Fed an A and fiscal policy an F, and worries about the U.S. remaining a free market-oriented economy. And at the same time, you had Chamath, I don't know how to pronounce his last name, but he's involved with Virgin Galactic space adventures now. He also said he's never seen a bigger disconnect between the economy and the stock market. He thinks they've divorced completely. And you had other bears being featured regularly on CNBC and Bloomberg. Because the market did experience more volatility than it has in the last few weeks. So we've been scouring the landscape. And by the way, just in terms of that kind of talk and point of view out there, we actually like it when these individuals, whom we respect enormously actually, come out and start sharing their thoughts. It's part of the wall of worry that has been in place, we believe, since 2009 and now remains in place. The wall of worry has created the opportunity for a very strong bull market. Bull markets that just go straight up without stopping, without a lot of cause for concern, they don't tend to be the healthiest bull markets. This bull market, and I am going to call this the continuation of the bull market. It was interrupted, of course, dramatically by the coronavirus. But I think in hindsight, that will be viewed as an interruption in the bull market. And we've talked about that on previous videos. So the wall of worry is a good thing. And we do want those who are concerned to keep those of us who are less concerned honest. So just to focus first on fiscal policy, monetary policy, and then some economic statistics. So fiscal policy, I still am hearing out of the administration the desire to get, as part of the next relief or stimulus package, a payroll tax holiday through the end of the year. And this is not the kind of holiday where employees and employers will have to pay it back next year, but an outright holiday. So an incentive to get back to work on both sides, both businesses and employees, to earn as much as possible this year. Then we are seeing this package evolve. We know that states and localities are under tremendous fiscal pressure and do need some help. And it's going to be tricky because some of these states had been having major problems well before the corona crisis, and they need to deal with those decisions often made a long time ago about pension plans and so forth. They're going to have to work through that or end up in bankruptcy, and no one really wants that, of course. We know that Tesla stirred the pot this week by opening up against Alameda County's wishes or directive. And we also saw that President Trump came out supporting that. So I think that this debate, which was primarily around healthcare before, is now moving into really the economic realm. We are going to lose a lot of jobs, and the infrastructure for continued growth is going to be damaged considerably if we don't open up. So this idea of life and livelihoods has taken on new life, and Elon stirring the pot. I think he's doing the right thing, and one of the reasons I do is because he's been informed, importantly, in China, in the Shanghai plant, about the best way to open up. What are the safety measures to take to protect employees? And I'm sure we will hear a lot about how that is going, but it seems to be going pretty well in Shanghai. So we'll see what happens there. One of the fiscal policy measures that is not gaining favor, I should say, is the capital gains tax rate cut. And, as a Laffer disciple, I would say that would be one important way to offset some of the damage that's being done by including incentives not to work out there. And of course, that was unavoidable. It looks like it's unlikely, but if they do pull that one out of the hat, I think this market will continue to gain terrific momentum. On monetary policy, Chairman Powell came out this week and gave his point of view, testifying. And, we learned that he seems more concerned than most. And I think he was coming at it from the healthcare point of view, worrying about the return of the virus. And again, this is good for us to keep thinking about. It's also another brick in the wall of worry. But we also saw he really is throwing more of the responsibility for getting the economy back on track to fiscal policymakers. So really prompting them to do whatever they think is the right thing. In other words, he says monetary policy can't do this alone, and that's absolutely true. It was interesting as in the last couple of weeks to see the support for Bitcoin grow. We saw Paul Tudor Jones coming out and saying he believes that Bitcoin is the protection that gold offered in the 70s. And of course, he made his fortune back then and his fame. And so he has some credibility in this regard. He had only dabbled with Bitcoin until now, but now he's including it as an insurance policy against any kind of disaster, but importantly against the inflationary repercussions of monetary policies around the world having really opened up the spigot completely. And so he's expressing some fear about inflation out there. Again, wall of worry, something we need to think about. And we also saw J.P. Morgan doing a serious about face, not Jamie Dimon himself, but J.P. Morgan basically talking about supporting and integrating with cryptocurrency or Bitcoin exchanges out there, which was very interesting. So J.P. Morgan also sees a reason to get with the program, and it may have to do with what their economists and strategists are saying about the impact ultimately of the fiscal and monetary policies that have been put in place around the world because of the coronavirus. So I'd like to take you through some economic statistics. And we saw some much worse than expected numbers coming out, retail sales and industrial production. Retail sales for April were down 16.4%. Think about that. That is not an annualized number. It's not a year-over-year number. It's from one month to the next. So from March to April, down 16.4%. Expectations were for down 12%, I believe. Yes, down 12%. And the previous month had already taken retail sales down 8.7%. Just looking through the details of the retail sales report, we saw, I think furniture was down 68%. That's month to month. And clothing, now this would be in bricks and mortar retail establishments, clothing down 80% month to month. We saw e-commerce and I guess it's a combination of e-commerce and mail order sales. Month to month, they were up 8%. So if you were to annualize 8% per month, you'd be almost at 100%. So huge shift to online, benefiting Amazon importantly. You know, we looked at the Amazon results when they came out, and I thought, those weren't as good. Yes, there was an acceleration in online sales. And then when we really thought about it, of course, it only included March. The second quarter could be much, much stronger. Their sales had been slipping into the low 20s, and before the coronavirus, it looked like they might slip into the high teens. Now we've reversed that, and it could be that their sales growth reaccelerates towards 30%. Which is phenomenal for a company the size of Amazon. Industrial production expectations were down 12%. It actually was a little better than expected, down 11.2%, even though retail sales were much worse. And this is the first glimmer that maybe this notion that businesses had become so cautious because of the inverted yield curve and the China U.S. trade conflict before the coronavirus, that they have not needed to adjust as much. In fact, they were behind the curve. We truly believe they were behind the curve before. We got some inflation metrics, CPI down negative 0.8%, and I think that takes the year over year to 0.3%. So no inflation effectively. Probably moving into a deflationary environment, certainly because of oil prices. And the PPI was down about 1.3% month to month, and on a year-over-year basis, down 1.2%. So the input prices for many companies are actually going down right now. So the purchasing power is increasing not just for some companies, but for consumers as well, of course. Last week, I featured the average hourly earnings. Well, real average hourly earnings from March to April increased 7.5%. 7.5%, think about that. And that's not a year-over-year number. That's month to month. And what this is telling us, once again, is the high-income earners probably are keeping their jobs while the low-income earners are losing theirs. So there's a huge mix shift taking place here. And the other metric we got that impacts the consumer is initial claims. Initial claims came down, not as much as many expected. But they've dropped below 3 million now, and we do think they will continue to go down now that we are seeing more states open up. We got some very interesting numbers today that I wanted to share, and I think this is one reason that the market did not respond badly, as badly as many might have expected to the retail sales report. We got out of the University of Michigan, which is the best consumer confidence index out there, we believe, some metrics that suggest that the consumer is already feeling better. So University of Michigan the expectation for the University of Michigan's consumer sentiment report was a decline from 71.8 to 68. Instead, we saw an increase to 73.7. Now, to compare some of those metrics, if you wanted to understand how this compares to 0809, the low back then was 55.3. So we're very comforted by that number, especially given our point of view about a much stronger snapback than many people expect. The other very big surprise in that index was inflation expectations for the next year. Now, last month they were 2.1%, and expectations were that that number would go to 2%. Instead, and I've never seen this before in this index, it popped to 3%. And there are probably two reasons for that. One is because of the hoarding and because of fears of meat shortages as meat processing plants close because of the coronavirus. There have been price hikes in the supermarket, which clearly in the consumer's mind have dominated the oil price declines, gasoline price declines, because they're not driving. So they're not as aware, but they're not driving as much, maybe to the supermarket, but the food prices are making much more of an impact on them. So that was very interesting. Now, the reason that's interesting is when you listen to Chamath and some of the deflationary bust fears out there, you realize that the only way that can happen is if people believe that prices are going to start falling. And remember, we think they are on a year-over-year basis starting next month on the CPI. But if you get into a deflationary mindset, the fear is prices falling means people are going to wait to buy whatever is falling in price. And if the consumer, as measured by this sentiment, and it is a really good measure statistically, probably the most trusted of any, if the sentiment is that prices are actually going to go up, you'll have the opposite effect, that maybe they'll start buying a little bit more, like they have been hoarding, to beat those price increases. So reassuring from this deflationary bust mindset. And so with that, I'd like to go into a few other statistics that came out of our companies or the companies we watch closely. One of them is Redfin. Redfin, like Zillow, is more online in its orientation when it comes to real estate transactions. And it is saying that the pace of that there's been a big surge in page views for small town residential. For small town residential, it was up 85% as of the beginning of April, and 105% as of the beginning of May. And that's raised a very interesting conversation at ARK, at least. It could be that, yes, people are looking for second homes if they live in the city, but maybe now that we're learning how to work online, and it's been pretty seamless for many knowledge workers, maybe we could escape high tax states like New York, like California, like Connecticut, get a place somewhere far away, maybe in a small town where the purchasing power for homes and otherwise is a much better deal. Avoid the taxes from New York by working 6 months there and maybe 6 months in New York. To be honest, I'm thinking of that. And I think others are as well. So that's one interesting notion that gets back at the plight that some of these high tax states are going to face during the next 3 to 5 years. You're seeing states compete even today to get the economy going again. Florida and Texas are saying, hey, baseball teams, come on down here if you want to start the season. You have Texas. Yeah, we're open for business. Anyone who wants to come down here and pay 0 state taxes. Same with Florida. I guess New Hampshire, Tennessee, and Nevada are the other 0 state income tax parts of the country. I really think this is going to become more important. We're already seeing an exodus from New York and California. I think it could accelerate for this reason. So that was interesting. We're also seeing another important move announced this week was TSMC, the Taiwan Semiconductor fab company. It is putting up a plant in Arizona. It's committing to it, at least. It won't be open until 2024, but that's $12 billion going into the Arizona economy, which is really interesting. So supply chain, bringing it closer to home, we're beginning to see the early stages of that. So that's also good for the U.S. And then maybe the most interesting stat we've seen from one of our companies is Tesla. Tesla put out, Elon Musk last night put out a graph showing the percentage use of its charging stations as the use of its charging stations as a percent of their maximum capacity. And it was really interesting to see they have a view on China, throughout Asia, and throughout North America because of this. And what we saw in China was a V-shaped recovery. So bottomed at 30% in early February, and then within 2 months shot up to 100%, and now is fluctuating in the 80 to 100% range. In the rest of Asia Pac actually, the number was it was hardly disturbed. It stayed well above 70%, and actually has continued to move up here, which in the sense of a trend, which is interesting. And then we've got North America and EMEA. They look very similar. It looks like they bottomed in April. Europe a little bit below 30%, and the US a little bit above 30%, if I remember the numbers correctly. And they've come up some, not as quickly as China did, but Europe's up to, I think, a little bit over 40%, and the US is closer to 50%. So hopefully states competing with each other to bring activity to, if not new residents and new jobs, down to and up to their states. Hopefully that's going to stir the pot a little bit and get our economy going a little faster than might otherwise have been the case. Meanwhile, just to finish up on the markets, again, the volatility in the equity market kicked up a bit. It had been dropping steadily, kicked up a bit this week, not tremendously. We did see the Treasury bond yield drop back, had gone into the mid-70s. This is the 10-year Treasury bond in the U.S., and now it's gone back to roughly 60 basis points. So again, flight to safety, a little bit of fear there. And we've also seen the credit default swaps in the industrial sector and in the consumer discretionary sector still levitate, which is saying, hey, we don't know who's going to go bankrupt and who's not. It was interesting to watch Penney halted this morning, the stock price. And Most people thought it was because it was going to announce bankruptcy and a restructuring. And instead, it announced that it had made its latest interest payment, I think, on May 14th, and the stock shot up 60%. So there's a lot of uncertainty still in those very vulnerable parts of our economy. But hopefully, as we're getting back to work, getting back to restaurants, some outdoors only, but here in South Carolina, they just opened up indoors as well. I'm feeling it's palpable, this sense that, hey, we do want to support these establishments, make sure and give those waiters and waitresses or servers, however you like to call them, an extra big tip to support them in this difficult time. That's sort of, I think, an important contribution we all can make as we're helping the economy get back to normal. So with that, and hoping this economy makes great strides within the next week, and the global economy continues to rev up, led by China. Hopefully, we'll have more good news. We know the stats are going to continue to look terrible on a month-to-month basis here, but the glimmers of light that I've shared with you today, I think, are really important, especially the consumer sentiment and the inflation one. Not that we want inflation to go crazy to the upside, but what we don't want is this fear of an expectation of deflation to drive spending decisions, meaning delay them. So in a weird sort of way, I've never rooted for inflation before, and I'm really not rooting for it now. But though I do worry about it in the out years, we did get some good news, and the turning around of consumer sentiment, mostly, by the way, because of present conditions, not because of expectations about the future, was really important. So I'll leave you with that good news and wish you a wonderful weekend. Bye-bye.